And, when I think about those three areas, taxes right now are low historically. Inflation is low historically, and market returns have been very good.
Yeah.
So it's like the perfect trifecta, for a client's financial plan. And obviously financial plans will give a probability of success of, being able to fund the goals and the wishes for the client. And those three factors, do make, contribute and affect that probability of success. So.
Welcome to Wealth and Life, where you'll learn with financial planner, consultant, speaker, and business owner, Tony D'Amico. You'll hear stories from successful business owners and individuals about how they navigated the inevitable challenges that arose as they achieved each new level of success. And you'll get insights and strategies from leading wealth planning professionals on how to achieve your next level of success. Now here's your host, Tony D'Amico.
Hi, my name is Amy D'Amico, and thanks for joining us for this episode of Wealth and Life podcast. Today, we have Tony D'Amico, who is the founder and managing partner at Fidato Wealth. We're going to talk about something important today, and we're going to talk about the current planning challenges in today's environment and how to navigate those challenges. So, Tony, what are some current topics that you've had on your mind when you've been managing the portfolios that we utilize for our clients and the wealth planning we provide for our clients?
Yeah, that's a really good question. And I really think the landscape has changed, and there are different things that are front of mind, right? And financial planning, investment management, is always about opportunities and risks. So, but, in today's landscape, as I kind of step back and, look at where we're at and think about where we're at, there's several factors that come to mind. So I think of, taxes, inflation, and market returns, right? So, with a client's financial plan, those all play a big, important role in the plan, as well as, their life assumptions too, their life expectancy, how much they want to spend, all those sorts of things. But the economic assumptions, right? Taxes, inflation, and market returns, those are all in some assumptions too in the plan. And, when I think about those three areas, taxes right now are low historically. Inflation is low historically, and market returns have been very good.
Yeah.
So it's like the perfect trifecta, for a client's financial plan. And obviously financial plans will give a probability of success of, being able to fund the goals and the wishes for the client. And those three factors do make, contribute and affect that probability of success. So, so that's something I've been thinking about a lot lately. And, I also, in my role, I, do a lot of, I would say, research and reading. And I always focus on economic policies. So, the economics of things, never the political side of things. So let's kind of throw that out there right now. This is strictly going to be kind of a discussion of just economic policies, and just looking at the there's I did continuing education. I do continuing education for for my certification of the certified financial planner. And one of them that, I attended actually late last year, had the new administration's tax proposals, and kind of looking at that and their proposals, right? It takes an act of Congress to, for something to, become law, and also just kind of keeping abreast of that. It's been unfolding. So reading, data-based articles, not political based at all, but just about what's being proposed and how that could affect, clients' financial plans, in the future. So there are, clearly some tax increases that are desired. So we have to look at how that could impact a client's financial plan, and, based upon what their goals are, what adjustments, we should make.
Mm-hmm. Yeah, that all makes a lot of sense. And I can just also add, as your wife, that, because I see Tony morning, noon, and evening, he does listen to economic information constantly, listening to podcasts all morning, always walking around with an earbud in his ear, and really keeping on top of everything that's going on out there. He spends an awful lot of time gathering data, gathering information. So also, I wanted to know, Tony, what are some scenarios or examples that you can think of in regard to the current economic conditions that have impacted a client's planning meeting?
Yeah, that's a good question too. Let's kind of just stick with taxes. For the most part, not all clients, everyone's different, but most of our clients want to be tax efficient, and they want to do tax planning, and they want to take advantage of kind of the clear black and white vanilla tax strategies that are in the Internal Revenue Code that, and the Internal Revenue Code does encourage Americans to take advantage of, all the tax, strategies available to them. That's the majority of our clients. And, our goal is to know, what's important to our clients. So I've never had somebody yet tell me that they wanted to pay more taxes, but I'm actually prepared for that, because you can actually write a check to the Treasury Department if you would like to, give money. But I guess to kind of give an example of that, tax planning has always been something that we've been focused on. And I'll kind of give an example there. So, one, I would say common strategy that we utilize, especially for our clients that had a professional job, contributed to a 401k, and they've, done a great job saving, and it's all pre-tax, right? So they've done such a good job, but they do have a growing tax problem. Yeah. And, when we look at their financial plan, and, eventually they have to take a required minimum distribution from that IRA in the future. And if we just look at kind of, average rates of returns and kind of just have reasonable assumptions, and I think that's important too, to, utilize historical inflation, have the current tax code in the financial planning software. But when we look at, what their required distribution will be from their IRA in the future when they turn 72, for some clients, it will push them into the 28% tax bracket or the 33% tax bracket, sometimes even higher tax brackets. So they do have a growing tax problem because they were, really diligent about saving for their future. But that IRA grows tax deferred, and then you have to take the money out of that. So a lot of times, I want to say, a good bit of times there's opportunities, not for all clients though, but for some where they're in a lower tax bracket in their earlier retirement years. So, perhaps they're not starting Social Security right away, to take advantage of that guaranteed growth and that guaranteed annuity, basically, that has that cost of living adjustment. And, sometimes there's that opportunity where their tax rates are lower, their tax bracket is lower for a period of time. So sometimes that's 2 years, sometimes that's 7 years. So we've always focused on is, perhaps if a client has room within their 22% tax bracket, right? Because you can make up to a certain amount of income
Mm-hmm.
and be in the 22% tax bracket. But it's not just earned income, it's also distributions from your IRA, or in this case, what we would do is a Roth conversion. So to convert the traditional to a Roth, you have to pay tax on the money at that point in time. But there we're helping the client make a strategic decision and say, hey, it's better to pay 22% now than, let's say, 28 or 33 or 39%, in the future. And this is all based upon current tax codes, what the tax code is today. The tax code will sunset, which, the current tax code that's in place, it was not passed by a supermajority, so it was not permanent law. So it was only law for 10 years. And that, expires, December 31st, 2025. So come January 1, 2026, tax rates will change unless Congress takes action, between now and then. But to kind of get back to the strategy, so if if somebody's going to pay 22% now, convert a certain defined amount with the help of a CPA over the course of, several years, what that does is it slowly transitions monies from the traditional IRA to the Roth IRA. And with the Roth, then it grows tax-free and you can take income from it tax-free, as well. So you do have to have the Roth IRA open for 5 years. There's a couple other nuances which are manageable. But then you have that tax-free growth and you can take income from it tax-free, and there's no required distributions that are needed or required from the Roth. So what that does is it lowers the required distribution in the future from the traditional IRA, because that required distribution, that amount is a function of your age and the amount of the traditional IRA, how much you have in it. So what we're doing is slowly kind of and very tactfully converting. We've done an analysis. We've run an analysis to compute what is the lifetime tax savings. So I could think of one scenario. Just the other day, the client, was saving $535,000 in income taxes over the life of their financial plan. Again, with what we know about tax rates could change, returns could be higher or lower, and all that will affect that. But they're, with kind of just looking at averages, they're going to save that amount in income taxes. So that is substantial. Now, getting to the change that we have seen, we have had, because of, the potential for higher taxes, right? We've had some clients say, and what about filling up the 24% tax bracket, and maybe doing more Roth conversions. Mm-hmm. So to answer your question, the first thing I would say that comes to mind is kind of sticking with our approach to tax planning as part of a comprehensive wealth management plan, and then just reevaluating if it makes sense to alter it and just in light of, where things are. So, there's always pros and cons. And, if we just had that crystal ball of, what will taxes be? What will inflation be? How long will somebody live? All those things, we could tell them exactly right what to do. But with taxes, that's kind of, I kind of gave you a bunch there, but that's, kind of, where we're at. And also too, I would say just always being the voice of reason for a client. Some clients are more concerned about taxes, and maybe they want to do some drastic things. So those can have consequences, right? Sometimes too, if people, maybe just aren't aware of, what their lifetime tax bill will be, our job is to obviously educate them, know what's important to them, know what their goals, values are, what they want to accomplish with their money, and then just have, educational and, being fiduciaries, our clients want us to be proactive with them and give advice. So, and write that, help them see, kind of determine what scenario is best given their circumstances. So, yeah, it's continued focus, on that, because it's, it makes a huge impact in a client's plan. And it's not just I'm talking more than I thought I would, but it's not just Roth conversions, right? I mean, we want to take advantage of, there's a decent amount of room in the 22% tax bracket. So, for most clients, that's kind of a no-brainer. So there's different ways to take advantage of the 22% tax bracket. It's not just Roth conversions. It's also, well, I'm in the 22% tax bracket. Maybe instead of contributing into the pre-tax portion of my 401k, let me forego that tax deduction. Let me contribute into the Roth 401k that I have access to at my employer. And those are the things that we highlight and bring up as potential strategies, for the clients that, that we work with. So sometimes it's where you save your money heading up to retirement. It's those conversions. Sometimes too, if you're in a lower tax bracket, even while you're working. So conversions don't just happen when someone retires. And then, if somebody has an investment account that is not an IRA, not a Roth, right? It's just an individually owned account or a jointly owned account, and there's gains in those accounts. Well, capital gains tax is also very low historically. And capital gains is also tiered. So you can have a certain amount of income and there's no capital gains. And then the next bracket is 15%. And then the next bracket is 20%. So, whenever we can harvest gains because it's up and obviously not pay any capital gain tax, then we want to do that. But again, that capital gain kind of goes to it's not taxed as income, but it kind of, starts to fill up that tax bracket, right? So, sometimes 15% is, a client, will say, hey, this thing is up a lot, perhaps let's harvest some of the gains and pay the tax obligation now. One of the things that is on the docket for, that they've been talking about extensively is changing and increasing capital gains tax. Yes. And so again, how do we take advantage of the lower tax brackets, for our clients? And, and then too, that often affects their financial plan. So then if they do that, and, I was meeting with a client the other day where we've been working with them for, over 10 plus years. So we've planted a lot of these trees a long time ago. And, the saying, the best time to plant a tree was 20 years ago. The second best time is today. Well, if you do these strategies, and, this is kind of a long-term perspective, and that's really also important to note. It's like, well, what do you do with the money? So that's another piece of it too. Sometimes it's increased, financial security,
Right.
Maybe helping grandchildren out more, could be charitable contributions. So it's, wealth management is a never ending event, but
Right.
So that's kind of with taxes,
I was just thinking, a lot of the planning that you do around taxes is meant so that when a client comes in and they tell us what their goals are and what they'd like to achieve in retirement and beyond, we want them to achieve those goals. So working on any way that's possible to save on taxes, like the Roth conversions and such, that money that's saved on taxes is then there for them to use to meet their goals, such as finance long-term care or other such goals, correct? Mm-hmm. But that's in the future. So mm-hmm. Do you ever find that it's kind of it's trying to balance between a person wanting to live now, but also knowing that they need to prepare for the future too?
Yeah, I mean, that's the yin and yang of this, is you need to have a quality of life today and you need to have a quality of life tomorrow. So striking that right balance, and then just, constantly, educating the client on, where they're at today and how this all, works, and using some good visuals as well to illustrate things. But yeah, But I mentioned the other thing that's been on my mind is inflation. Um, and, you know, you know, it might seem odd because everything is going great, but really, when it comes to inflation, here's why it's on my radar. So number one, it's been historically low. Number two, the Fed has a written statement on what their desire for inflation is. The Fed wants inflation to be higher, flat out, and that's fine. But and again, I'm just telling you what the economic policy is. But specifically, the Fed has said too in writing that they want personal consumption expenditures to be that they want that inflation to be higher. So that's a specific basket of goods that also more so relates to what a client would spend their money on, right? Core inflation is made up of a certain basket of goods, right? But, healthcare has inflation, right? Food is more sporadic, has a little bit more, food prices have more challenging inflation than some other things do. So, the Fed has come out, in statements saying that they want employment to be very low, which is great. They're not as concerned with inflation. And that's a different stance than, previous statements from the Fed. So historically, the challenge has always been, or when there has been a lot of inflation, hyperinflation, right? And that has happened when our economy has overheated. So they want very low very low unemployment. Hopefully I'm using the right words. They want very low unemployment. They're, setting interest rates accordingly to accomplish that goal. So the number one goal is lower unemployment. They'll take higher inflation to get to that goal. And again, I have no judgment on whether that's right or wrong, but they are leaving room for inflation to go up. And there's different things the Fed can do, the Federal Reserve can do through its monetary policy to control inflation, interest rates, and in these things, right? So if we do have higher inflation, right, that will change, financial plans. So financial plans have done better, the last 10 years because inflation has been low. Now, we use 3% for inflation in our financial plans, right? Historically, long-term, it's been about 2.9. So we use 3%. We use the historical average as well for healthcare, because that is not 3%. That's in the 5% range. And also college expenses don't inflate at 3%. So we use a long-term, historical averages. So plans assume, right, if they're done the right way, right, they assume that the expenses are increasing by that inflation factor each year, and making sure that your plan can, withstand that. So I think it's just really important. When I think of the economy, there are certain publications that are economic based, and I read those, and it's data driven, right? So, but then I also have my own eyes, and I see, I've seen different, I have business owner clients, right? We also have clients that are business owners, and in different businesses, all sorts of different businesses, home builders, dental practice owners, manufacturers of different types of products, real estate investors. So, and I also have, peers and friends that are located in different parts of the country. And, I've spent, some time in other states, and you see how strong the economy is, how strong the demand is for certain goods and services. There are certain areas where, for example, the demand for that good or service is so strong that the materials that they need have gone up in price substantially. So being in financial services for over 20 years now, I've been part of these cycles before, and you just don't know. And are we going to do anything and like make some sort of rash decision or drastically change, the investment? No. Could there be adjustments? Yes. Are there adjustments to a financial plan? Yes. But it's always with that long term in mind. It's always looking at the evidence and never trying to guess. But why I'm saying this is the economy is strong. And I see it on paper, I see it with my eyes, and like, okay, well, if it continues to go this way, things will, and they're actually just this month, right? There are certain costs that have gone up, right? Home building, for example, right? The cost of lumber is through the roof. So if somebody's looking to build a house now, the materials are so much higher than they ever have been. And so the demand, and not just home building, but different areas of the market, have really, really heated up. So just keeping your eye on inflation and, what is that like, maybe if you're listening to this or watching us, how does that change your plan? Or how would that adjust things? So number one is I want to make sure that a client doesn't have too much inflation risk, meaning that they don't have too much money in cash. We like our clients to have 3 to 6 months of living expenses as an emergency account that, should be in cash. That's really important. If you start to have a lot more than that, then you're going to have that inflation drag because banks are paying 0.5%. Let's say if inflation is 2.5%, then you're losing 2% buying power, right? So how do you manage inflation, making sure you don't have too much inflation risk? You can't be too aggressive either. So kind of pairing strategies that have different pros and cons is really important. With inflation too, it's, again, the fundamentals. It's being focused on the plan, helping our clients make sure that they're taking Social Security at the right time. There's many strategies with Social Security, which I actually just recently did a separate podcast on that. But Social Security is a really unique asset. It grows phenomenally well. If you defer it, it'll grow 6% from 62 to full retirement age, and it grows 8% from full retirement age to age 70. So if you defer from 62 to 70, it's about a 76% increase in the benefit. Now, it's not right for everyone to do. But that, we're talking about inflation. Social Security is basically a guaranteed annuity, right? It's the guarantee is based upon the government making good on that commitment to pay those funds. But it also has a cost of living adjustment as well. So, if there's higher inflation, your Social Security payment will go up. And portfolios tend to not do as well when there's investments not do as well when there's higher inflation. Mm-hmm. So again, it's looking at really, somebody's total financial picture, their total balance sheet, if you will, and making sure that they're kind of optimizing things to best handle inflation. Also too, it's important to, with inflation, right? Stocks, having access to stocks or equities, is important, right? Because that has offered a hedge against inflation over history. So, making sure that the fundamentals are there, kind of sticking to those long-term fundamentals. I know I've probably said that quite a bit, but just kind of looking at things too. I think it's important. What I'm trying to say is to kind of, always looking at things with a fresh mind is really important. So with inflation, those are kind of some of the things that, that we're looking at. So
Yeah, it's a lot. It's really like a chess game, trying to get all the pieces to be in the correct spots to work properly. So it's a lot of work. Yeah. And you might have answered this a little bit, but how is it best to proceed in light of current economic conditions?
Yeah. Right. If I had the crystal ball. You know, I guess the other factor too that I mentioned was market returns, right? Market returns have been really good, right? We had that dip with COVID onset, a substantial dip, and we rebalanced 7 times during kind of that period of time to take advantage of that volatility for our clients. So, market returns have been really good. And so what do we do there? How do we kind of move forward? I would say it's relentless discipline is number one. So continuing to rebalance when things, grow out of band. So if the target allocation is here, let's say the target allocation for a certain investment is 15%, but it's grown to 20% because that particular asset class has done really well. So to rebalance that, sell it off, so you're back down to your 15%, is really important. I think we call this threshold-based rebalancing. So it's not calendar-based driven. It's based upon the investments growing out of band or dropping below, like out of band. And I think ongoing rebalancing is really important. And I would say discipline too is also really very important. Staying disciplined, and to kind of stick with the plan. And and the reason why I say that is because sometimes when the market goes up, people get a little bit, what's the word? And I'm not, I don't blame people. It's kind of how our brains are wired. So we tend to get overconfident when market returns are higher. And I think that's probably one of the biggest things that, somebody that's listening could take away is, yes, returns are good. It doesn't mean that we should, take more risk. It doesn't mean that we should go in and buy Bitcoin if that wasn't, the strategy before. It's not getting overconfident. And overconfidence is actually been studied extensively. It's part of a field of study called behavioral finance, where these psychologists have studied people's decisions and if that decision resulted in a financial gain or loss, right? And as you can imagine, that overconfidence, hey, things are going well, let's take more risk. Let's, that often does not, that story does not end well.
It's like, let's take more risk. Things are going well, so that means they'll always go well. It's
exactly.
Sort of that it could change.
Yeah. I mean, like it's 2021, but your strategy has to work for the long term, right? It has to work in 08 and 09. So having the right investment strategy that, maximizes gains without taking any additional risk is, really important. And that long-termness, I love a Warren Buffett quote. He said that the stock market is a device for transferring money from the inpatient to the patient.
Yeah.
One of my very favorite quotes. And I think that actually applies to investing, but I also think it applies to wealth management and financial planning, because these strategies are not like, hey, you're going to, get a quick result. It's all
Right.
about, the long term and letting the results surface and come to you. So, but yeah, with market returns, it's, that's kind of been the focus there is, helping our clients understand their risk profile score. And, I would say, and it's okay if we want clients to ask questions. Like we want them to say, hey, what do you think about this investment? And I'm happy to do that. And we want that open communication. And again, no judgment there, but we do obviously will spend time to show them, how their portfolio, how much it's gone up over the past year, and how their investments support their financial plan as well,
Right.
is really important. So, with market returns, that's kind of the focus, with planning moving forward. So, but I think to answer your question, so, that's, I would say focusing, like what should they do kind of moving forward in light of current conditions, really keep your eye on the ball, right? Don't get overconfident,
Mhm.
control what you can control, enjoy the good times too. Don't get me wrong. You want to enjoy when things are going well. And we've done that too. We've encouraged clients to make an additional purchase because their returns, have been much greater than expected. But it's also to keep an eye on the long term and what those potential risks might be, and to, make, a good decision, carefully weighing out the pros and cons. I think the other thing that comes to mind is, we do, regular meetings with our clients. So there's no way to do all this. So if, somebody works with an advisor, to have those regular ongoing meetings, and, really assessing where you're at in light of what's important to you and identifying what strategies apply, because the available strategies are different based upon a person's goals and their financial situation. So, there's certain things that one person can control. There's some other set of things that somebody else might be, able to control. So that ongoing relationship with that advisor, and make sure that, I think too, it's really important to keep abreast of economic changes, tax law changes, and then how does that affect the the plan. So it's really it's kind of a never ending process, which again, it's important to enjoy the fact, right? Our clients have, our financial planning clients have, plans that are adequate to meet their lifestyles. They're successful plans. So, we didn't tell any clients to reduce their spending. The clients that reached out to us in March and April of 2020, we didn't, if they were retired, we said, hey, your portfolio is built for not just sunny days, but also rainy days. That's why you do all of this stuff.
Right. Right.
But I guess in a nutshell, control what you can control, keep that active, open communication, with your advisor, make sure that there are multiple people too involved, not just your financial planner, but, having kind of an integrated wealth management experience between the financial planner, your CPA, your estate planning attorney, those types of things. And just watch out for overconfidence.
Sounds great. Those are really good takeaways for our podcast listeners and clients today. Thanks, Tony, for sharing all of your insights. We really appreciate it and look forward to scheduling another one of these podcasts where we can hear you speak and we can kind of pick your brain a little bit, and you can help us understand what's going on out there in the world and how to reflects in financial planning?
Well, this was our first podcast together to our listeners, right? So I was a little bit worried that Amy was going to be tough on me. Nah, I'm just joking. If you guys have listened this long, you will know that I married up in many different ways. Amy is also a managing partner at Fidato Wealth, and I've enjoyed the professional conversation, and I'm sure we'll talk about this at dinner tonight. All right. Thanks, Amy, for being a good host today.
All right. Thanks for talking with us, Tony.
Do you want even more ideas, tools, and resources on how to achieve the next level of success in your wealth planning? Check out wealthandlife.com, where Tony will cover the latest trends and wealth planning best practices for successful business owners, families approaching retirement, and comprehensive wealth management. And by subscribing to the Wealth and Life podcast, keep up to date with future episodes. Get it all now at wealthandlife.com. Wealth and Life is created and hosted by Tony D'Amico, founder and managing partner of Fidato Wealth LLC, a registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations. To determine which strategies may be appropriate for you, please consult a financial planner prior to making any financial decisions. Any case examples discussed are hypothetical, and any resemblance to a particular person or business is purely incidental. Please visit wealthandlife.com for other important disclosures.